Kamau Thugge is the central bank governor of Kenya. This year, the bank received an A, the highest grade of global finance, and it's an achievement for the bank and is the first one for the Bank of Kenya, Central Bank of Kenya.
I think when I became the governor of the central bank, we found a situation where the inflation was quite high. We found a fairly dysfunctional foreign exchange market with a depreciating currency. And we put in measures to address the inflationary pressures. We raised interest rate, the policy rate of the central bank quite significantly, and we implemented some reforms in the foreign exchange market. We also did some liability management on a Eurobond that was falling due. And as a result of all those measures, we were able to stabilize the exchange rate and also the inflationary pressures. So currently, our inflation is about 4.6%. Our core inflation, which is the bulk of the CPI of 81%, and that is running at 2.9%, which I think is quite reasonable. The exchange rate has also stabilized for the last 1.5 years. It has been range bound between 129 and about 130, so that's been good. And we have a lot of resilience now in the economy. The economy now is growing by, in the first half of this year, grew by 4.9%, and we can see the acceleration because we have started to ease monetary policy. Interest rates by commercial banks have started to come down, and credit to the private sector has also started to go up. So we expect by the end of this year for not only to have continued stability with the exchange rate and inflation, but also we expect the growth of the economy to reach at least 5.2% for this year and 5.5% next year. The key issues was very, for me, was very important. There was the highlighting of the global uncertainty, both trade and tariffs, and the fact that there's reduction in official development assistance for countries like ours. There's a lot of debt service is quite important in terms of reducing fiscal space. And the issue was, in the context of all these difficulties, what should we do? I think for me, it really emphasizes the need for domestic resource mobilization, both on the revenue side, but also to develop your own capital markets, deepen your capital markets, so that you're able not to borrow domestically without really pushing up interest rates and without having to depend on external financing. Our main concern is obviously to ensure that we sustain the stability that we have, the macroeconomic stability that we have, that we continue to stimulate the economy without setting off inflationary expectations. We need to create jobs going forward, and we also do need to. We have a new framework for setting interest rates. We are really trying to modernize the way the whole monetary policy framework works, to ensure that there is the transmission of monetary policy decisions to the economy is much more efficient. Whether we are raising the interest rate, we should be able to see that normally happens. The banks are very quick to raise the interest rate, But when we want to lower interest rates to stimulate the economy, there's a bit of a lag. And I think that is what we want to address, so that when we lower the policy rate, there is an immediate impact on a commercial bank interest rates, so as to stimulate credit to the private sector and growth.